Money Radio for a really great future. We're talking real money.
Welcome to Talking Real Money. Yes, it's podcast time again. Well, okay, it's always podcast time. It's always Talking Real Money time, almost every single day except for some holidays and some weekends where we don't do podcasts. But we're doing one right now, and we're glad you're a part of it. Today, we want to talk a little bit about the latest, literally latest and greatest investment vehicle to come from Wall Street. Now, they invent a lot of things, but every once in a while, they actually get it right.
This one is, by the way, the investment du jour. You got to say it is, right?
It totally is. I mean,
it's for at the top of the menu. Yeah,
for
right
us
there.
to have totally changed our tune.
Yeah.
And
frankly, our tune wasn't that harmonious anyway. So,
well, speak for yourself. I was singing of mutual funds.
Well, and I don't know how to answer. Was I humming to annuities?
I don't know what you were
doing.
doing. Were you doing a harmony? I have no idea. Okay, and the thing we're talking about is the thing that has sort of usurped the mutual fund in our portfolios. It's called a fund, but it's an exchange-traded fund. Interesting history and interesting situation currently with ETFs. It's a huge market. And as it gets bigger, people, of course, want to find their little niche in it. But it's a great story, the story of ETFs.
I love this article. It's up on Morningstar. Anybody can go read it. I think if you go to Morningstar and type in exchange-traded funds or ETFs.
Got to be literate.
Well, okay. Anyone who can read read this article. It's a great history because it helps you understand where we are today. And my biggest worry about where we are today with exchange-traded funds is what you just mentioned. It's new, and people think new is necessarily better. It's not the case. And that's what this article walks through. And the history is fascinating. I had not realized, or perhaps I'd forgotten, that they go all the way back to 1990. Wow, that's a long time ago. I mean, and we really think.
I don't even, and I was doing a financial radio show in 1990, and I don't remember them being talked about.
And it says here that was a State Street really got the first one going back in 1993 with SPY, which is a very popular.
The Spiders.
Yeah, the Spiders, very popular, of course, exchange-traded funds. And just to jump ahead, today, there's 4,000 exchange-traded funds. We're going to talk about which ones we think you should pay attention to, and about $8 trillion or so in them. I mean, this is a big market, right? This is not insignificant in any fashion.
Yeah. How much money is in mutual funds? I wonder how much that is.
I think it's about, I want to say twice that, or 15 to 20. Anyway, so it's a lot. So, okay, but let's just give a little history just so you understand kind of how we arrived where we are. I think it's important, but I like history, so I'm happy to talk about that. And we'll talk a little bit about the problems we see in exchange-traded funds. So exchange-traded funds really didn't, other than the aforementioned SPY and a few others, really you got to get to about 2000 before anybody starts to pay much attention, right? And what were they doing early on? Early on, it was indexes, right? Mm-hmm. They were taking the S&P 500 or the Russell 2 or whatever it was, and they were putting together inexpensive and tax-efficient investment vehicles.
That was the goal, was the tax efficiency was one of the main goals of these, but also lowering costs and making the trading more efficient. It was fascinating. And the SEC was a little bit reluctant.
They
initially
dragged their feet. Yeah.
Oh, they did. That was like, why is this better than a mutual fund? Is it better? Is it more complicated? What might happen to them? The SEC was very conservative, as were we.
Yeah. Oh, yeah. We took a long time before we jumped on this train. So, okay. So that gets us to somewhere around the mid-2000s. You get these, a few of these exchange-traded funds that are tracking indexes. Seems like a good idea. People throwing money at them. Well, as soon as people start putting money into them, guess what happens? Didn't you just say something about Wall Street a minute ago? Hey, wait. People are investing in those.
Those are good.
We better have some of those. So then the track starts to veer a bit. And things like, what are they called? Strategic beta exchange-traded funds get added, right? They go beyond just broad market indexes.
Those are like the DFA and Avantis product.
I know. I'm not picking on them. I'm just saying that's kind of when things kind of started going that direction. Not strictly indexes. they had rules based, of course, but they weren't exactly where the industry started. Okay, again, so far I'm okay with everything that's happened, but then you get into what I've mentioned. Money goes into these funds. Other people on Wall Street say, we got to have some of that money. And they start throwing every possible strategy out there that you can invest in. And a lot of this came about, by the way, after the 2008 financial crisis, the 2010s. And I love this quote from the author who says, novelty grips investors. Boy, isn't that true? Because we hear a lot from you like, I hear the Avantis funds are really good. I got to own some of those. Well, you already own 4 index. You don't need the Avantis. I mean, but they're new. They're exciting. I got to be part of that. And so ETF providers started coming up with all kinds of new ones, but not things we think you should pay attention to. Single stock ETFs, niche ETFs.
That doesn't. It's single stock ETF. What is the point of a single stock ETF? Couldn't you just buy a single stock and?
But if it's a huge price,
ETF?
can you buy partial shares of it? I always forget with the can you do that? So if
no, you have to buy round shares of the ETF. You have to buy one share.
Yeah. So I you know what? You tell me. It's not something we'd recommend.
It's a gimmick.
It is a gimmick. And then, of course, our friend cryptocurrencies, and people started using these for wagers, which is not what investing should be, right? Making big bets on, again, particular parts of the market, single stocks, using leverage, all those kind of things, to the place where now there are 4,000 exchange-traded funds at the end of March 2025. And the author does a nice job here. And again, I think if you're interested in this, you go to Morningstar and you can read this piece because I think it's fascinating. But
do you want to give them a title so they can find it?
I don't have that in front of me. Wait, I don't. Maybe you do.
No, I don't, but I'll look.
We could find it. So, okay, but then, so we have all these 4,000 funds, and many of you ask us oftentimes, how do I pick? I mean, what do I do here? Well, he helps you a bit by saying, look, I only think you should pay any attention to a fund that's at least $1 billion, which sounds like a lot, but frankly, in today's investing world, that's a pretty small number. So he eliminates a bunch of them. That takes you down to 738. Then he, because he works at Morningstar, says, well, let's focus on Morningstar's top asset managers or those with above average or high parent ratings. That reduces the list to 461. So you start to knock it down. But the part that I think you should pay attention to in this article is really only working with exchange-traded fund companies that are reputable, that you can trust, because there are so many ideas. And that's the thing I hate about exchange-traded funds is people invest in ideas rather than strategies. This is like, I saw this, I heard this, I got to get into it. And he lists a bunch of the families he thinks you should pay attention to, which includes PIMCO, which I don't think you should. JP Morgan, which I don't think you should invest with. T. Rowe Price, no, I wouldn't put my money there. The Capital Group, isn't that American funds?
Wait, are they doing ETFs now?
They're apparently doing ETFs. They're on his list of people he thinks you should pay attention to. But the ones I like that he mentions, Avantis, yeah, we're good with Avantis. Dimensional, okay. Fidelity, I think they have some reasonable low-cost exchange-traded funds. That's fine. Charles Schwab, sure. BlackRock, yep. State Street, absolutely. And Vanguard. I don't think you need to go outside of that group because that can get you anything you really want in terms of the type of fund. You could find very low cost. You could use index and you could use smart beta if you have to in any one of these places, basically, rather than finding these more speculative places, Don, that we know end up badly for most people. That's the problem.
You know, it's really interesting. A couple of things. You said it's investing is not gambling. Well, the reality is a lot of people think it is.
Yeah.
They think
zero-sum game.
Investing is a zero-sum game, and that's very sad because it shouldn't be. The fact of the matter is many of what they just suggested in this article, those are actively managed fund groups across the board. I mean, Capital Group, although I got to tell you, their fees are not awful for an actively managed ETF. On the Capital Group Core Equity ETF,
how much?
Their expenses are 1/3 of a percentage point,
which is far lower than they're charging with their mutual funds.
Oh yeah, it's much lower than that. So if you're going to get American funds,
you got to own them
that way.
Yep,
but,
exactly. You don't have to pay commission either. So
it's only got 72 stocks in it.
don't recommend anything with that
it's
view
not
of equities.
Really well diversified.
Yeah, not diversified.
Now, bear in mind, Morningstar also recommends these other companies, PIMCO and the like.
Not a fan
because they advertise with them.
Oh, so there's a conflict of interest. You're saying?
You think there's a conflict of interest?
Maybe. So,
I mean, honestly, I think they should say in these articles, the funds that we suggest pay us. Some of them pay us advertising fees. But they don't.
Yeah,
you think they would.
Seems but here's the little bit of, we've seen this the last few years, the confusion that I have exposed, I guess, to I'm surprised by that many people believe because the investment's an exchange traded fund that it's a good investment because these are new and these are really cool. We just mentioned about 3,500 of them that you shouldn't get close to touching. Absolutely 100% not. New does not mean better. And the other part is when they're complex in the way that many of these are. And I think I just sent you one, didn't I, from Motley Fool right before
the new Motley Fool.
Plane.
Yeah, it's 3 years old. The Motley Fool ETF.
Pardon me.
Yeah, I looked it up. It's, by the way, though, it's done really well.
Oh, okay. Well, then that's a good reason. I'm glad they're advertising it everywhere.
It's 50 basis points. It's 0.5%.
Yeah. So I wonder how big that is. I bet it's still probably more than a bill, but probably pretty small. So these principles that we apply to mutual funds should hold with exchange traded funds. Broad diversification, low cost, tax efficiency you already have. You don't have to be too smart to take advantage of that with ETFs, but I'd add another one because from what I see when people walk in and we meet with them with exchange traded funds, they're complicated. I am always a fan of keeping it simple, and you can do that really well with these exchange traded funds. And again, I don't want you to have a series of ideas here. I want you to have a strategy that you plug in the funds to meet that strategy, right? Globally diversified, the right mix of stocks and bonds, that kind of thing, rather than, and we see this often in the questions, Don, that people ask us, hey, I heard there's this new fund. Should I own it? That's one thing we hear a lot.
And I want to go back to that list that you recited, the list of active and passive ETF fund families groups. Because I'm so bothered by it because on the active side, it literally in the active column, they have Avantis, Capital Group, Dimensional, Fidelity, JP Morgan, PIMCO, and T. Rowe Price.
That's right. Dimensional and Avantis get lumped in with those other guys.
And that's where, and we've discussed this with David Booth at Dimensional,
exactly.
With Weston Wellington at Dimensional, with Apollo Lupescu at Dimensional,
Eduardo
Repetto at Avantis. We've discussed this with these guys, and because they have rules, they technically fall because they're not just buying an index.
That's right. They are active, therefore,
and that's because it's a binary option.
It is, which is
they
not
don't
correct.
give you two options, and I hate that. There should be a middle option, which is actively passive or passively active.
Come up with something. When you come up with that, give me a ring, would you?
I came up with passively active.
Passively active. It's sounding a lot like my first marriage, so we better not go there. So I don't know.
Something. I remember. Oh, David Booth said he would buy someone dinner.
Did he say where? Because he is worth like whatever
he
$1 billion.
He had put no limits on it, so I would imagine it'll be a very nice dinner if someone can come up with a term that the industry can use to define those ETFs and fund groups that aren't active in that they don't pick stocks.
Yeah, and they don't time markets. They don't pick stocks. And by the way, there are some very nice restaurants in Austin, Texas. So you run down there, I'm sure David
Austin
gets you.
Yeah. Although I read a recent article, I think it was in the Journal, that said Austin is losing its cachet, that a lot of tech firms are they're missing the good old days back in the Bay Area.
They're going to head back
and
to the West Coast.
they're moving back there because of the environment. That there are more people who think the way they do in San Francisco.
The flower children have returned to the Bay Area.
It's more of a tech world, and Austin just didn't make it they didn't go as far in the tech. A lot of people have tried to be the next Silicon Valley.
Yeah.
You've got the Research Triangle in North Carolina.
Sure.
You had, Austin. You've had.
We do okay here too in the Great Pacific Northwest.
But again, it's still not the same cachet as Silicon Valley because it's so Microsoft. It's so Microsoft centric.
Well, we have like Amazon or something, right?
Yeah.
Guys,
But
right. Fair enough. We're not taking that one on today.
Want to get
I know
into
you.
it.
I know
I
you
do. I so
and
want
you'll
to.
win because you know more about this than I do. I will say this, having just come back from Portland, that might be a good place for a tech breakout because they have the highest vacancy rate in commercial buildings.
I hear you
go
can
downtown.
buy a big pink building for almost nothing.
I know that. What was it, like 80% less than it was 5 or 6 years ago?
5 years ago.
Oh,
I think it was 5 years.
God,
They say
crazy.
5 or 10 years.
I think it was right before COVID. All right, so back to the exchange rate fund. I have no idea how we arrived where we did.
What's the message? What is our message?
The message is, okay, the message is you, and I'm going to use a you message here because I see it many times, get excited when you read about something new. You probably shouldn't. Exchange rated funds are not really new. You should really only trust the fund families have been around for a while doing this and know how to do it and are not promoting new ideas, new things, single stock, it's crypto, all that other stuff. So, but exchange traded funds are a good investing vehicle, especially in a taxable brokerage type of account because of their tax treatment. So that's the message. But don't run off and just use exchange traded funds because they're new and they're cool. I guess that's where I'd leave it.
Okay. So don't use the new and the cool. Use the
stodgy,
the tried and the true.
Like Talking Real Money's guys, the old and the stodgy.
We're really old.
That's right. So
yeah, as a matter of fact, I was looking back through my old drives trying to find old Talking Real Money shows.
Yeah.
And I can only currently online we have them going back to 2018.
That's it?
That's it.
Wow.
So I went looking and I found them back to 2014, but I can't find any prior to that.
Okay. When I get home, I'll try the Dark Side of the Moon because, where I live, you can kind of tuck around there and I'll see if they're hanging out there or something. So
I don't even know what you mean.
All right. How about some questions?
I have no idea what you just said.
All right. Let's
go
to
Dark Side of the Moon?
Ron from Drexel Hill,
really?
Pennsylvania.
Is it past your bedtime?
Pretty close. Yeah. Bail us out. It's been a couple of days. Ron writes us.
He's jet lagged.
I know,
from his 31-minute flight from Portland to Seattle.
29 coming back because he had the southerly wind.
Got a tailwind.
You got a tailwind from Portland. It's really tough. Ron writes, I listen to the podcast all the time. Thank you, Ron. He says, Tom and Don are great. I was curious what you think about Facet Wealth. Facet. Facet Wealth.
Can't spell facet.
They seem to be a legitimate fiduciary fee-only firm, but I was surprised that they're pushing an alternative income strategy approach that is high cost and potentially high risk. That seems to be an oxymoron from a firm that traditionally believes in the benefits of low-cost passive investing. This, again, from Ron in Drexel Hill, Pennsylvania. And by the way, I'm reading Mr. Atkinson's book on the Revolutionary War. You guys in Pennsylvania, you did not come out at the Battle of Brandywine. You would have saved Washington, but you didn't show up. They said they had like 50,000 members of the militia, but only 2,000 showed up or something.
There were a lot of Tories in Pennsylvania.
Yeah, I guess so. But there were a lot of militiamen who just decided to take the weekend off.
I'm looking at them.
Facet Wealth Alternative Income Strategy. I don't know the firm. I don't know the strategy.
I know their fee structure now. They charge flat fees, very unique in the industry. A complete dedicated CFP professional is $6,600 a year.
But you can't find the alternative, alternative income strategy.
Facet Alternative Income Strategy. I
usually don't like things that are labeled alternative because it suggests something unique, cool, whatever about it that creates a worry for me.
Facet Alternative. Okay. Here we go. They call it a strategy that aims to diversify your portfolio by investing in assets beyond publicly traded stocks and bonds.
I had a sense it'd be something like that.
Private loans, real estate, income strategies. They do have illiquidity problems. The investments themselves tend to be more expensive. So what you might save in their flat fee, you might more than make up for in their additional fees for the investment vehicles. No list of what those vehicles are, nor what they cost.
So we're not sure. Ron must have talked to them to know because he calls it a high cost and potentially high risk. So
yeah, it's potentially very high risk because it's very difficult to know what the quality is of what you're getting into and what it's worth, because these are more often than not illiquid assets with little or no secondary market. The secondary market is thin, and it's hard to price them day to day, week to week, month to month, even.
You've heard us talk about these things in previous episodes.
We don't like them.
No,
we would never, ever work with somebody. We don't sell these alternative strategies.
Nope.
And we don't think that that they make a lot of sense. It's trying to differentiate them. They're trying to differentiate themselves.
They don't want to be just a passive shop, if you will.
Because then they're commoditized. You need a firm that's going out there and doing cutting edge, fancy stuff, and they got to be careful because they are a 100% fiduciary advisor. So they really have to be careful about the advice they give and to whom they give it.
Yeah, because you get the wrong person into something like that that's illiquid.
Exactly.
And it goes down, you could be in trouble.
There is not a broad, all-encompassing fiduciary standard in the law. It means you must do what is in the best interest of each individual you're advising.
That's right. It's not a blanket. It is per person. So I think in this case,
they say they're a fiduciary. I'm sure they mean that. But I could see with some of these illiquid things, and of course, nobody thinks it's going to happen.
It never does until it's 2008 or 2020 or whatever it is.
Nobody expected that big, tall, pink building in Portland would plunge by 80% in 5 years. And
we got to be careful. The building itself did not plunge. The price of the building plunged, just so people don't worry. The building still stands.
Yeah, right. Yeah. Portland is not sinking that I'm aware of.
No, well, it may well be. So in this case, can we say we can turn the faucet off? The facet off.
It's the facet. It's not a faucet. Okay. Jet lag.
All right. Andrew from Frederick, Colorado. Do you know Frederick?
I do know Frederick.
Okay.
Yep.
You went to high school with him or something, or how do you know him?
I don't know someone named Frederick, but I know Frederick, Colorado.
Okay. He says, I'm
a Coloradoan.
You're a Coloradan.
We like saying I like Coloradan, but somebody said technically it was Coloradoan, and
that's too much. He says he's looking for a quick sanity check. I wanted right back. You call them the wrong guys.
Particularly today, you should not.
Exactly. Woo. My wife and I each got raises last year. That's awesome. That collectively put us over the 236,000 mark. If I understand correctly, I'm up to date on the latest numbers. That means that we can no longer contribute to a Roth IRA. We looked this up for a recent program.
Yeah, it was like the 260 something.
He says 236.
I got to look it up again.
I just can't keep all those things straight, and they change them. I wish they would stop doing that. That makes life so very difficult. But
it is now. It starts at 236 and then ends at 246.
Okay, so there'd be not much reason to do it between two because they're going to scale it down. So you're right. He says he previously invested his Roth IRA through Total Market Exchange Traded Fund, International Exchange Traded Fund, and a small cap ETF from Vanguard. He lists then the tickers VBR, VTI, and VXUS. Now that I can no longer invest in my Roth IRA, should I just keep investing in these same funds through a traditional IRA, or should there be a different strategy? Well, my answer is I don't know, because are you investing in a 401k, right? Because if you have an employer plan, you're putting money pre-tax in a 401k, you are, in a sense, saving in a qualified account. And by the way, at work, you can still, there's no income max there. You could put money in a Roth 401k as well. I personally would prefer, Andrew, seeing you take that money and put it in a taxable account, because now you're going to get some pre-tax growth, and the taxable account is going to be, so it gives you different buckets, if you will, to draw on when you go to retire. Or, by the way, you could consider the backdoor Roth IRA, which would be putting money into the IRA, taking it out right away, and being able to make a contribution for each one of you. But what's your take, Don?
Yeah, I like, if you want the Roth, the backdoor is a wonderful way to get a Roth. It just gets you in.
Yep.
I wouldn't. Did they have regulars?
They didn't say. Doesn't say.
The only downside is if you have regular IRAs.
Then you're going to do the pro rata. You don't want to do that. Yeah,
because of the pro rata. Then I wouldn't do it. Yeah. But if I don't have regular IRAs, if everything I have is Roth, then heck yeah, I do the backdoor.
Yeah. And if you have an IRA and you can't do that, then I'd go to the taxable account after that. That would be my take. And the funds you picked, very, very good, Andrew. So thank you for writing.
Yeah, absolutely. Thank you very much.
And
do
keep
you want
writing.
To do anything else? Or you
no,
good?
I want to keep writing. We've gotten a lot of questions lately. Let's keep them coming because we got some vacation time coming up and stuff. So we're trying to put things in pre-recorded things so that we have them ready to go. So how do I say that? Jet lag. So working ahead. Yeah. So please keep the questions coming. Love them.
All right. Well,
by the way, you can do those at talkingrealmoney.com in case you didn't know. Just
talkingrealmoney.com or on Saturdays you can call us at 855-935-TALK, 855-935-8255. And we are working on a way that we can take live calls from you during the week. Hopefully we'll have that out sometime over the summer. It's going
to be crazy, man.
Yeah.
Yeah. Looking forward to that. Oh, we should probably, I was just thinking this. We should probably give the option to some of our biggest fans, people that have been listening since we started, let them be the first callers on our new interactive.
How would you do that?
I'll call them up. I know them.
Oh, you'll call them and let them know.
We got a guy who's been to every retirement meeting. He's listened to every podcast.
Then
it's not going to really work. No. And by the way, people I met with this week in Portland, thank you. I enjoyed the meetings, and they had all listened to every podcast every week. Thank you for that dedication. Wow. That just really made my day. Apparently not enough to be a coach at the next day, but still made my day that day. So, okay.
It's that little moment that counts. We're glad you were happy for a moment.
It's tiny. The synapses were working and everything. And it's gone.
He's getting ready. It's been a while. He hasn't had a vacation in a couple of weeks.
I know.
When did you get back from Phoenix?
I don't remember.
Yeah, it was like a couple of weeks ago.
A couple of weeks ago.
And you're going to Europe in a couple of weeks,
right? Yeah. I'm taking a break from my vacations to do this podcast. I hope you're happy with that.
So glad you decided to spend a few moments with us.
Appreciate it.
You're so busy. All right, everybody. Thank you. Thank you for being there. Thank you for telling friends. Thank you for sharing our podcasts and us. We're glad you do, and we hope you'll keep doing it. And remember, be like these other people. 5 times a week, except on weeks with holidays, you should be listening to Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.